Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within company filings. Today we're diving into AB Private Lending Fund's latest report, and it looks like they've been busy making some significant changes to their borrowing arrangements. Trust me, this will be more interesting than it sounds at first glance. Now, what is the big news here? Well, AB Private Lending Fund, or the company as they call themselves, has inked a deal called the First Amendment. Think of it as a major update to a previous agreement they had about borrowing money called the Credit Agreement. This isn't just a little tweak, it is a really important update that changes how much money they can borrow when they have to pay it back and how much it costs. This First Amendment was signed on the 15th of September 2025, and it revises their senior secured credit agreement from May 2, 2024. The main players here are the company itself as the borrower, the lenders who provide the money, and the Bank of Nova Scotia acting as the main agent, sort of like the manager of the loan. So let's break down what this amendment actually does. First, they extended something called the revolver availability period. This is the time frame during which the company can actually borrow money under this credit line. They pushed this out from May to 2028, all the way to the 14th of September 2029. This means they have a longer runway to access these funds if they need them for their business operations or growth. Following that, they also extended the scheduled maturity date. This is the date when the entire loan amount is supposed to be fully repaid. They pushed this back from May 2, 2029 to the 13th of September 2030. Basically, they giving themselves more time to pay back the money they borrowed. This can be a positive sign showing they're remanaging their debts and perhaps expect to continue generating enough cash flow to meet these extended obligations. Now, here is a big one. They increased the total amount of money available under this credit facility. It has gone up from $100 million to $125 million. This is a 25% increase in their borrowing capacity. This suggests the company is either planning for more growth, anticipates needing more capital for its projects, or perhaps they've shown enough financial strength to get lenders to offer them more money. It's important to remember that increased borrowing capacity does automatically mean they will borrow more, but it does give them flexibility. They also managed to get a better deal on the fees. They're now paying a lower fee for the money they haven't actually borrowed yet. This fee, called an unused fee, has been reduced from 0.375% to 0.325%. While it might seem like a small percentage, on a large credit line, this can add up to significant savings over time. It shows they're renegotiating effectively and potentially getting better terms from their lenders. Now, this next part gets a bit technical, but it is crucial. They've also reduced what is called the applicable margin. This is essentially the interest rate charged on the money they do borrow. The rate can change based on something called the gross borrowing base compared to the combined debt amount. When their borrowing base is strong enough, meaning it is at least 1.60 times their combined debt, the interest rate on what they call ABR loans, which are basically loans tied to a bank, S-prime rate is now 0.825% per year. That's a pretty competitive rate. However, if their borrowing base is less strong, meaning it is not quite 1.60 times their combined debt, the rate on those same ABR loans goes up slightly to 0.950% per year. There are also different rates for other types of loans they might take, like term benchmark loans and RFR loans, which are generally higher. The key takeaway here is that the interest rates are more favorable when their financial position is stronger, which is a common and sensible structure for these types of credit agreements. Finally, they've also reset the minimum shareholders' equity test. This is a financial covenant, a rule that the company must follow. It means they have to maintain a certain level of equity, which is essentially the value of the company that belongs to its owners. By resetting this test, they might be adjusting the minimum amount of equity they need to hold, possibly to accommodate their growth or changes in their financial structure. All this information about their credit agreement is important because it directly relates to how the company manages its money and its debts. Item 2.03 in this filing confirms that these changes create a direct financial obligation for the company, which is pretty standard for any credit agreement. This entire deal, this First Amendment, is detailed in an exhibit called Exhibit 10.1. The filing mentions that they omitted some of the finer details or schedules from this exhibit, which is common practice to keep the publicly filed document concise. However, they promised to provide those omitted details to the C if they asked for them. And of course, no modern SEC filing is complete without the cover page interactive data file, which is basically a machine-readable version of the report's main information. Now, let's look at AB Private Lending Fund's situation. They appear to be a company that is actively managing its financing and looking to expand its access to capital. The increased credit facility and extended repayment terms suggest a strategy focused on growth and financial flexibility. By successfully negotiating lower interest rates and fees, they're also demonstrating a capability to secure more favorable terms with their lenders, which is a positive attribute for any business. However, there are always things to watch out for. While they are an emerging growth company, which allows them some regulatory flexibility, it also means they might not have the same level of financial reporting history or stability as a more established, larger corporation. The increased borrowing capacity, while positive for flexibility, also means a higher potential for debt if they choose to use it fully. Lenders are essentially betting on the company's future performance, and it is up to AB Private Lending Fund to ensure they can meet these new obligations. In conclusion, AB Private Lending Fund has made significant updates to its credit agreement, signaling a proactive approach to managing its finances and supporting its business objectives. They've secured more money and more time to repay it, with better terms, which is generally good news. But as with any financial maneuver, it is crucial to keep an eye on how they utilize this increased capacity and ensure they can comfortably manage the added debt. Alright, that is our breakdown of AB Private Lending Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this expansion is a smart move or a risky one? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribing means you won't miss our future deep dives into corporate filings. Don't forget to check out our Discord community linked in the description for more discussions on finance and investing. Thanks for watching, and we'll see you in the next video.